What is going on, YouTube Nation? This is Art Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So you guys have been sending me messages like crazy with monthly dividend stocks that I own and why I like them. So I'm going to update you guys on my dividend stocks that I have and why I like them and why I'm long in them. So I will do a review on dividend stocks that you guys are requesting. So, make sure you hit that notification bell after you subscribe. So you guys are like going crazy telling me like to review stocks, but I'm going to do 5 of them. You guys wanted me to do a top 5 list of monthly dividend stocks that are hot right now and that I like and I'm long in. And again, this is not financial advice for entertainment purposes, only disclaimer in the description. But I'm going to show you why I love these stocks and why in the future I'm going to try to get to 100, 200 shares in these stocks and just let it fly with my monthly dividend income. So let's check these stocks out right now. So the first dividend stock I want to go over is EPR Properties. I loaded up on these guys once the pandemic hit. They were at 19 right here. Let's go down here. I started buying these guys like crazy when this happened at 1805. So right now they're down, okay? They were somewhat in line with the S&P before the pandemic hit, and during their peak they were at 72.79. So they're way down. Dividend yield is 6.70%. PE ratio is 32.55. Volume is 524.08K. Market cap 3.69 billion. The year range is 4104 to 5638. Day range is $49.15 to $50. And its previous close is 50.20. So what do I like about these guys and why did I buy the dip? They're an experiential REIT. So they invest in like ski resorts, theaters, eat and play attractions, gaming, cultural. They're one of the biggest landlords of AMC, and people are starting to go into the theaters. So I just want to show you the distribution map first. So theaters, eat and play attractions, ski, experiential lodging, gaming, cultural, fitness, and wellness centers. And I'll go to their portfolio real quick. They have 355 locations, 200 plus tenants in 44 states in the US and Canada. So ski resorts are starting to get big. Fitness and wellness centers are huge. They have a little bit of private schools and early childhood education centers. That's not really as big as the attractions and resorts that they have. So one of the biggest things is since things have closed and are opening up, these guys are very attractive. And this is why I loaded up on these guys, because I knew eventually, and again, this is not financial advice for entertainment purposes, only disclaimer in the description, these guys would resume, and their dividend history was fantastic. They had consistent dividend hikes. They just resumed their dividend again, which I'll show you guys in a second. But let me show you their revenue and how much these guys were hit hard by the pandemic. So this is in millions US dollars. Look at this revenue that they had an increase in. This is kind of why I like VC properties as well. So 2015, again, they are well diversified. They're a specialized real estate investment trust. So you shouldn't have all your eggs in one basket when it comes to real estate investment trusts. You should be well diversified. Medical REITs, entertainment REITs, NNN REITs, triple net lease REITs, industrial REITs, which I'll go over shortly. 2015 right here, millions of US dollars, 421. 2016, 493. 2017, 518. 2018, 639. 2019, 651. Pandemic hit. Look at this huge drop, 414. And then 2021, 531. So they're slowly making a comeback. People are starting to go on vacation. I know the economy's taking a beating a little bit right now. That makes these guys even more attractive. And this is why in a few months, when I start travel nursing, I'm going to start throwing money in these guys. I want to get to 200 shares in my long-term goal. And I'll show you their dividend history. So I'm going to go as far as 2014. Again, this is a monthly dividend real estate investment trust. It was 29 cents. In 2015, it hit 30 cents. 2016, it hit 32 cents. 2017, it hit 34 cents. 2018, it hit 36 cents. 2019, it hit 38 cents. Then 2020, it was at 38 cents. And then they finally resumed their dividend once things started waking up and people started going on vacation again. And, the government, basically CDC, said it's okay to open these places. So people started having confidence again. And these guys resumed their dividend at 25 cents. Then they just hiked it to 28 cents. So they're at a discount. So the payout ratio is 85%. I'm not too worried. Number of dividend increases in the past 5 years is 4. The dividend growth in 5 years is negative 4.68%. You can blame the pandemic. Dividend yield is 6.70%. And the annual dividend, if you bought one share, you made $3.30. So I'm going to hold these guys. I'm going to be long in them. And I really like the way things are going with these guys. And again, took a major beating. So that's kind of a given. Let's jump to the next dividend stock. And this is Main Street Capital. It's sitting at 37.57. It has a dividend yield of 6.87%, a PE ratio of 7.75. The volume is 373.24K. Market cap 2.74 billion US dollars. Its year range is 35.30 to 47.13. Its day range is 37.50, 38.14. Its previous close is 38.02. So they have a high dividend yield right now. And at one point, they were doing decent against the S&P, a little bit lower than the pandemic hit, and they were way down. And then they're still trying to gain some ground. So I just want to emphasize this too. Real estate investment trusts, as well as business development companies, 90% of pretty much what they make have to go back to investors. So that's one thing that's nice about business development companies and real estate investment trusts. So let's go over Main Street Capital very quick. The Main Street Capital, which is in Houston, Texas, has helped over 200 private companies grow or transition by providing flexible private equity and debt capital solutions. Privately held businesses turn to us because we are Main Street, not Wall Street. We build relationships and tailor transactions to meet the unique needs of our portfolio companies and their owners. I need to get this coffee kicking in me. I literally woke up and I'm going to do a quick video for you guys. So let me show you the portfolio companies. They're very well diversified. So right here, their sectors: business, services, commercial and professional services, consumer discretionary, consumer service, energy, financials, healthcare, industrials, information technology, manufacturing, materials, media, and telecommunications. They just had a recent transaction. So I can't even say these guys. They're a leading supplier of equipment and supplies to the veterinary profession. So as you can tell, they're just so well diversified. This is what I like about them. I will go over their revenue and their dividend history. So these guys seem to be a pretty decent growth, monthly dividend growth stock, and dividends distribution is pretty nice. But let's start with their revenue. Check this out. 2015, this is in millions US dollars, 164, 2016, 178, 2017, 205, 2018, 233, 2019, 243, 2020 pandemic hit, they're at 222. You can understand them going down. Then 2021, 289. So from 2015, 164 to 2021, 289, that's very attractive. So these guys are increasing in revenue, which I really like about business development companies. Now let's go over their dividend history. Let's start in 2015. They were 17 cents. Then they hit 18 cents. You got that little special dividend at 28 cents. Then 2015, they're 18 cents. Then you see that little special dividend at 28 cents in December. And then they're at 18. You get the special dividend, 2016. Then all of a sudden they hit 19 cents. And then they're just giving you those nice little dividends, which is nice. Again, at 28 cents. Then they hit 19 cents. And then you get that special dividend, 28 cents. They're 19, slowly going up. And they get that special dividend, 28 cents in June. So this is what I like about these guys, is they are slowly hiking their dividend. It's not too fast, but you're getting this special dividend at the end too. And then they crack 20 cents. And they get that special dividend of 25 cents. Then they crack 21 cents. You get a special dividend, 24 cents. And then they're 21, slowly going up. Again, they're still their dividends pretty consistent still, even during the pandemic. And then you get a little 10-cent special dividend. Then they crack 22 cents. Then you get a little special dividend of 8 cents right there. So the thing is, these are a business development company. I'm not too worried about their payout ratio being 91%. The number of dividend increases in the last 5 years is 10. Annualized dividend growth in 5 years is 2.68%. Big deal. They're pretty cheap right now. Annual dividend yield, if you bought one share, it's 258, and then it's 6.87% for a dividend yield. The payout ratio is high. Again, a business development company, 90% of what they make, they have to come back to us. But I like their increase in revenue and their at a cheap price right now, so this is why I really like these guys. And again, this is not financial advice for entertainment purposes, only disclaimer in the description. I will repeat that 1,000 times because I have to. Let's jump to the next dividend stock. And again, diversification is extremely important. Look, we have Stag Industrial Incorporated. These guys are a real estate investment trust focused on the industrial sector and industrial buildings. So they're sitting at 32.82. They have a dividend yield of 4.45%, PE ratio of 25.37. The volume is 1.63 million. Market cap is 5.88 billion US dollars. The tier range is 31.49 to 48.27. Day range was 32.76 to 33.46, and this previous close was 33.25. So these guys are not doing too hot against the S&P right now, and they're at a major discount. So let's go over these guys very quickly. So I said before, Stag is a real estate investment trust focused on the acquisition and operation of industrial properties throughout the U.S. By targeting this type of property, Stag has developed an investing strategy that helps people like you and I, who are investors, build a powerful balance of income plus growth. 551 buildings, 40 states, square feet 10.1 million, enterprise value 9.9 billion, and this symbol is Stag. So I'll just go over their properties very quick and go over their revenue and dividend history. So I'm going to just use my state as an example. So Cleveland, they have a lot of distribution warehouses. And right here in Columbus, Cleveland, Dayton, I mean, these buildings appear to have job security because, again, they're a distribution warehouse. Manufacturing, I mean, manufacturing isn't going anywhere. They're going to try to compete with, China and all these other countries, India. So that's still going to be around somewhat. But look at these type of industrial parkway buildings, which are like very attractive. So these are places that people need to be at. They are in demand. And this is what makes these guys very interesting, unique, and well diversified. This is why they're in my dividend portfolio. So I'm going to show you the revenue and dividend history. Again, this caffeine needs to start kicking in. This is what's so powerful about Stag. So again, since they're so diversified and in demand, they're still making revenue even when the pandemic hit. So look, 2015 millions US dollars, 218, 2016 250, 2017 301. 2018 350, 2019 405, 2020 483, and then 2021 562. So their increase in revenue is huge over time from 2015 to 2021. Now I'll go over their dividend history. So this is one thing I want to point out with their dividend history. It's very slow. So this is one where I'm probably going to get to 200 shares and that's it, and then see what happens. So 2014, 11 cents, 2015, 12 cents, and it's still cracking 12 cents. Eventually, they'll get to 13. And again, I'm not giving financial advice, but very slow. So the payout ratio of 70%, number of dividend increases in the last 5 years is 7. Annualized dividend growth in 5 years is 0.75%. Annual dividend is 146, and 4.45% is the dividend yield. So extremely slow. This is why I like EPR Properties a little bit more and Main Street Capital a little bit more compared to these guys. But this is still a hot dividend stock because of the diversification. Let's jump to the next dividend stock. I have posted numerous videos on these guys, and I still have to give these guys props because in 2021, the board of directors said with Agree Realty Corporation, we are going to be a monthly dividend real estate investment trust. So 2021, they became a monthly dividend stock, this slash real estate investment trust. This put them on the map. So Agree Realty Corporation, they're sitting at $69.98, a dividend yield of 4.01%, PE ratio 39.25. The volume is 858.56K. Market cap 5.26 billion US dollars. The tier range is 61.62 to 75.95. Stay range is 69.77 to 71.14. Its previous close was 70.75. So I'll go over these guys real quick. This is what these guys acquire. So single tenant assets, multi-tenant assets for portfolio sale leasebacks, industry-leading tenants, and short or long-term leases. So they are huge, and I would consider them a huge rival to Realty Income. They're a lot more smaller. I'm not going to post a video on Realty Income. Everybody knows about those guys. I'll do an individual one if you guys want me to in the future, but I'm going to show you their portfolio. But here's their target retail sectors, and it kind of reminds me of Realty Income. Home improvement, auto parts, convenience stores, tire and auto services, off-price retail, farm and rural supply, wholesale clubs, and grocery stores. They have 1,510 properties. Every time I go on their website, they start growing and getting bigger. 31 million square feet, 68% investment grade. So at one point, people were more companies were paying rent to them than Realty Income when the pandemic hit. Now look at this: Advanced Auto Parts, Aldi. These are the type of buildings they had. Amazon Fresh, AMC, Aspen Dental, AT&T, AutoZone. I mean, look at their diversification. How many people go to AutoZone? I mean, people need stuff done with their cars. So a lot of these, Burlington, Caliber Collision. I'm just going down. DaVita, Dollar General, Five Below, Home Depot, O'Reilly Auto Parts, Ross's Dress, Sherwin-Williams, people need paint, Starbucks, Stripes, Sunbelt Reynolds. I mean, there's a well-diversified portfolio for these guys. Sunoco, they have Taco Bell, people pay rent for them, Target, TD Bank, Texas Roadhouse, TGI Fridays. I mean, these are places that consistently pay rent to their landlords. Tire Kingdom, Tires Plus, TJ Maxx, Factor Supply. I mean, look at this diversification. It's unbelievable. I'll show you their revenue and dividend history. Look at how powerful these guys have become. 2015, 69.966, again, millions US dollars. 2016, 91. 2017, 111. 2018, 137. 2019, 187. 2020, 248. And then 2021, 339. That is huge. A huge increase in revenue. So I'm going to go over their dividend history. Let's start in 2017. It was a quarterly dividend stock, 51 cents, then 52, then 54, then 56. Then they cracked 57, then 2020, 59, then 2020, 60 cents, and then 62 cents. And then this is when they became a monthly dividend stock, 21 cents. Then they jumped to 22 cents. Then they cracked 23 cents. So they are consistently hiking their monthly dividend. Payout ratio is 74%. Number of dividend increases in the last 5 years is 11. The annualized dividend growth in 5 years is 6.48%. Annual dividend is, if you bought one share, you made $2.81 with a 4.01% dividend yield. Let's jump to the final dividend stock. The last one is Gladstone Investment Corporation. It's sitting at 1444. The PE ratio 4.69. Dividend yield 6.23%. Volume 112.63K. Market cap is 479.48 million US dollars. Its year range is 1369 to 1715. Day range is 1442 to 1469. Its previous close was 1461. What do I like about these guys? I'll reveal to you. The Gladstone Investment Corporation is a BDC, which is a private equity fund focused on acquiring mature, lower middle market companies. So let's check these guys out. They have business, consumer services, consumer products, and manufacturing. So they're kind of diversified. And this is what I like about these business development companies. Some of them who are very successful. There are some that just aren't very hot. But these guys I really like, and I'm going to go over their revenue and their dividend history. So in millions US dollars, 2016, 50, and then 2017, 51, 2018, 58, 2019, 59, 2020, 61, 2021, you can blame the pandemic at 56, and then 2022, $72. So that's a huge hike from 2016 to 2022, from 50 to 72. I like that, and I'll show you their dividend history, which I really like as well. Let's start in 2015. There were 6 cents. 2016, 6 cents. 2017, 7. They just cracked the 7-cent mark. 2018, 7 cents. You get that special dividend at 9 cents. June, and then at 7 cents. Then you get that special dividend of 9 cents. It's still at 7 cents. But again, these guys are so cheap. And then you get the 7 cents and then 3 cents. But guess what? They cracked the 8 cent. And then you get that special dividend of 12 cents. And then they're at 8 cents. So the dividend growth is a little slow in the past 5 years at 2.77%. Number of dividend increases in the last 5 years is 16. The payout ratio is 98%. I'm not too worried. Annual dividend, if you bought one share, you're at 90 cents, and it has a dividend yield of 6.23%. So I'm going to just follow up on this. Business development companies are extremely risky. Prospect Capital's one monthly dividend business development company. A lot of people like AGNC, but I like these guys because again they're a little bit diversified. I think Main Street Capital, again, not giving financial advice, entertainment purposes only, disclaimer in the description. But I like Main Street Capital the best as a monthly dividend business development company the most because their diversification, revenue's good, but gains is probably my number two monthly dividend business development company. So I own Gain in Maine. I'm long in those guys. I'm long in ADC. I'm long in EPR Properties, and I'm long in Stag. I really like EPR Properties just because of the discount right now, and hopefully they will increase their dividend to be back where they were at the 30-cent mark. So again, I like to be well diversified in my monthly dividend stocks and real estate investment trusts. So I think diversification is very important. I like the 200 share mark and then just reinvest the dividends and see where things go from there. I need to get to 200 shares, so that's my long-term goal in a lot of these monthly dividend business development companies and real estate investment trusts. So if you like this video, make sure you smash that like button. You got to hit the notification bell after you subscribe. You guys have been amazing subscribers on this channel and very active on this channel. We're almost at 9,000 Dividend Warriors strong as subscribers. So make sure you subscribe. I know a lot of you guys comment. I will do a review on these dividend stocks that you guys wanted me to. There's some very interesting ones. So seems like a lot of you guys like when I do sometimes on my days that I work, like individual ones, I sneak those in. And that's because you guys hit the notification bell. So you have to hit that notification bell so I can start squeezing in these videos so you can see them. All right, you guys take care and have a great Friday. And I will try to squeeze one in, maybe Saturday. Don't quote me on that. But Sunday, for sure, I will post a video for you guys. So you guys have a great weekend. And I hope this video was very informative for you guys. And again, almost 9,000. This is amazing. Like, ever since I changed my channel to being from nursing to dividend investing, I really like the change that I made a few years ago. And I did lose some subscribers because of nursing, but a lot of you guys stuck with it. And I, made new buddies on here, especially with a lot of you guys that are active on this channel. So you guys take care and have a good one.